The two tax benefits that I want to discuss with real estate include depreciation and 1031. So let me show you how this works. Let's assume that I'm a real estate investor and I go out and I buy this single family house for $200,000 and then I rent it out for $2,000 a month. When I rent this property out, I have expenses. So although I make $24,000 a year in rental income, I have to then pay my expenses, and I'm gonna assume that I have $14,000 in expenses, so I have $10,000 a year in profit. This is the money that's in my bank account at the end of the year. I'm not going to go through the real estate investment analysis. Let's just assume that I make $10,000 a year in profit. This is how much money I have in my bank account at the end of the year. Now, depreciation says I get to tell the IRS, hey, this property is 1 year older. And because it's 1 year older, I deserve a tax write-off. But the way that depreciation works is that you get to take a factor of how much you paid for the property, not the land, the property, and get to deduct that against your profit. So let's assume that your accountant says, yeah, it looks like you paid $40,000 for the land and $160,000 for the building. If this is the case, you take this $160,000 you paid for the building, and then you can do what's called straight line depreciation. What that means for single family homes, it's different if we're talking about multifamily and commercial buildings, but for single family homes, that means you take this $160,000 and you divide it by 27.5, and that means you get to take about a $5,800 tax write-off for doing nothing except owning a property that's now 1 year older. And so now you get to tell the IRS, hey, I made $10,000 of profit, but I'm only going to pay taxes on $4,200 worth of income. This is the base style of depreciation you can take. This is called straight line depreciation, and this is nothing fancy. This is the basic level of depreciation. Now, if you get more sophisticated, you might be able to go and say, I want to do something called accelerated depreciation. Now you're going to accelerate how fast you depreciate the value of this property, and now maybe year one, you can take a $20,000 loss, hypothetically. So this is situation two. So you made $10,000. So you have $10,000 in your bank account, but you tell the IRS, I lost $10,000. How much taxes do you pay on a $10,000 loss? Nothing. But this is where it can get even more sophisticated, because let's assume you're also working a job and you made $100,000 in a year from your job. Well, what the IRS says is this is what's called a passive loss. The $100,000 that you made from your job is called an active income. Normally, you cannot deduct a passive loss against your active income. However, there are a couple exceptions. If you make under $100,000 a year, you can take up to a $25,000 passive loss, which means I can own this $200,000 property. I can make $10,000 in profits. I can do this sophisticated accounting and tell the IRS I have a $10,000 paper loss, although I have $10,000 in my bank account. And then because I make $100,000 a year or less, I can then take this $10,000 paper loss and then deduct it against my income. And even if I made more money and I no longer qualify for the standard style of deduction, I can get even more fancy. If I made $1 million a year, hypothetically, and then I have this loss, I'm not going to qualify to take this passive loss against my active income. But what I could do is I could say, I am a real estate professional, or my spouse is a real estate professional. And because one of us are real estate professionals, now we can take this passive loss and deduct it against my active income. You can see it starts to get very complicated, but this is where you want to have a good accountant on your side that can help you find and understand how the tax code works. But at the core, what I want you to understand here is through real estate investing, you get to qualify for what's called depreciation deductions, which means you get to make money in rent, have a profit, and then take a paper loss. This is a paper deduction. This is a paper deduction. That means you're not actually paying this money out of pocket. This is a deduction you get to take on paper on your tax statement, which says you get to take this write-off because your property is 1 year older. And in order to do this, please get a good accountant, because if you don't have a good accountant, well, you might not get the deduction and you might do it wrong and then have to pay penalties, fines, and interest, which is not fun. You end up losing more money when you do that. The second tax advantage with real estate is something called the 1031 exchange, which says, now, let's assume you own this property for a few years. And hypothetically, this property grows in value over the next 5 years to $400,000. Now you have a few options. You can just sit on this property, you can do a cash out refinance, or you can sell the property. So let's assume now that you go out and you sell this property for $400,000. Now you have a big gain. You're gonna have hundreds of thousands of dollars of profit on paper, which means you're gonna have to pay a big tax bill unless you qualify for 1031. What 1031 says is if you take all $400,000 and you use this money to go out and buy a bigger rental property, you spend all $400,000 buying more rental properties, well now you don't have to pay a penny in taxes today. You were deferring all of these capital gains taxes. And the only time you actually have to pay those capital gains taxes is if, when you are living, you sell a property and then you don't do a 1031 exchange. So you could do this every 5 years. And you can do this until you die and never have to pay a penny in these capital gains profit taxes, because you can just keep flipping the property into bigger properties every few years. Now you can't be a real estate flipper and do this. You can't do this every 6 months. You have to own the property for at least 1 year, at the very least. And there's a lot of rules and regulations with 1031 exchanges with how fast you have to find new properties and how fast you have to close on the new properties. So again, if you're going to consider doing this, great. Just make sure you have a good advisor on your side, because there's a lot of rules and regulations that are involved. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.